Well, welcome everyone. Martin and I did not talk about what we were going to do ahead of time, but I think you will see that my slides dovetail very well with a lot of the concepts that he's talking about. He talked about challenging the conventional wisdom. I'm going to address what I call three big underlying misconceptions of active and passive. My marketing department says it's better to call them myths. It sounds sexier, but I call them misconceptions. And in many ways, they will get at some details behind what Professor Kramers was talking about. So one, I'm going to talk about whether markets are efficient or not, and I don't think that's really the issue. The second is that indexing is killing active management, and I'm going to make the argument that very much the opposite might be true. And then I'm going to talk a little bit about whenever you get in an argument with someone who is a zealot on passive, they pull out this knockout punch that Professor Kramers has already referenced on the arithmetic of active management, and I'm going to address how we feel about that. So first of all, markets are too efficient. I doubt that market efficiency is a huge driver of what's going on here. In the long run, that might be true. We could look at lots of asset classes, and maybe in certain asset classes, the average manager is 50th percentile or 55th or 45th. But what it doesn't explain is the outliers, those periods of time when the S&P 500 is way up in the rankings or way down in the rankings. In 1999, the S&P 500 beat 80% of the large cap blend managers. In 2000, 80% of the active managers beat the S&P 500. So I doubt that the market was massively efficient in 1999, massively inefficient in 2000. I also don't think it's largely about manager skill for the same reason. It's unlikely that all these managers were idiots in 1999 and they became geniuses in 2000. So what do I think is really going on when we see active managers fall and rise in the rankings significantly? It's probably not driven by efficiency or manager skill. It's driven, in my mind, by these active performance factors. And somehow my not equal sign ended up in the wrong place. But the sum of all the active managers does not, in my mind, equal the index. That's the heart and soul of the Sharpe paper that I'll reference in a minute, and what Professor Kramers mentioned. It's important that people understand there are systematic differences between a universe of active managers, the index that they run against. And these differences, in my view, largely explain the fortune or the misfortune of many of these active managers from period to period. What are some of these factors that we've looked into? The first one is market direction. There's empirical evidence that you could argue either way on some of these, but again, ceteris paribus, other things being equal, you should understand basically the direction of the effect. Market direction is the first one. The vast majority of actively managed portfolios hold cash. Market cap weighted indexes do not. Other things being equal, dramatically rising markets and indexes is not a good environment for active management. Similarly, when the market falls out of bed, it won't always be the case that active managers outperform or all active managers will outperform, but other things being equal, bear markets should help. Again, managers tend to hold cash that the indexes don't. Cap skew is important. The vast majority of managers, particularly in large cap space, do not run portfolios as big as the indexes. I looked at this a couple of weeks ago. According to Morningstar data, 80% of the managers in the large cap blend universe have smaller market cap characteristics than the S&P 500. So when mega cap stocks run, that's generally bad for active managers. And when the smallest cap stocks, I don't mean small caps, I mean smaller, the other 450 in the S&P, that's usually good for active management. Reason behind that is the vast majority of managers are not overweight mega cap stocks. You would eat up your entire portfolio if you tried to be 3 or 4% overweight the 25 biggest stocks in the index. You'd only be able to run about a 30 stock portfolio. Benchmark density is important. What I mean by that is how the cap looks. The S&P 500 is a fairly dense benchmark. It has lots of names with big weights and then a few that have small weights versus, say, the Russell 2000, where you have 2,000 stocks that all have really low weights. It turns out that the less dense the capitalization range in the benchmark is, the easier it should be to beat the benchmark. This has to do with active share that we'll talk about in a minute. But I always hear small cap managers say, well, I have over 90% active share. It would be almost impossible for a small cap manager to have less than 90% active share. The largest holding in the Russell 2000 is about 35 basis points. Largest holding in the S&P 500, Apple, is 4.5 basis points. So it's much harder to beat the S&P 500 than it is to beat the Russell 2000. And then in bond space, Professor Kramer said this, we look a lot at US equities, we don't look at other asset classes, but in bonds it's basically about credit. Most fixed income managers are overweight credit. We own lots of yield, and when we out-yield the benchmarks and credit does well, we do well. When credit falls out of bed, active managers do poorly. I don't think they're geniuses one day and idiots the next day. So during periods where active managers, when active management is either really in favor or out of favor, I really think it's about the math of the underlying portfolios, not the magic of market efficiency that you often hear about. Indexing is killing active management. They use this little thermometer chart. Why is it killing us? Because the vast majority of a lot of these asset classes, we can't get up to 50% of the managers beating the index. How do we get up there? I would argue that the competitive stresses of the success of active management is starting to passive management make the active managers better. You've all heard the misquote of Charles Darwin, close to what he said, but not actually what he said, that it's not the strongest that survived, that the most adaptable. And I actually think that adaptability is what passive is bringing to the active world. I call this portfolio Darwinism. It's the idea that the competitive pressures of passive indexing is making active more competitive. If you want to see, I'll talk about this in 2 minutes in a second. But if you just want to Google this, I wrote an op-ed that got printed in 5 or 6 journals, periodicals around the world. You can just Google how passive indexing will save active management, and you'll get 1,200 words on this subject. In more like 100 words, 5 things driving this Darwinism. Fee compression. Chip Rome was almost right this morning. He said that the average fee is not coming down. The average fee is coming down. It's just not coming down very much. It's come down over the last 10 years by about 4 or 5 basis points. So think of a large cap growth manager that used to charge 80 is now charging 75 or 76. But what he was right about is the asset weighted fee is coming down dramatically. Okay? The money is pouring out of high cost share classes and into low cost share classes. And a lot of those low cost share classes are going to disappear and will no longer be structural underperformers left in the benchmark for that comparison. So again, moving up that thermometer should be good. The waning use of soft dollars, whole bunch of other things are driving fee compression. And remember that indexes are bounded theoretically by the zero bound on fees. Fidelity just launched 2 funds that have a 0 fee to them. Active managers can continue to reduce their fees. Most of the major market cap indexes are pretty much done with that. Ruthless pursuit of alpha, machine learning, smart data, data scraping, liquidity management, acquisition of cash. Portfolios are becoming more efficient. The death of closet indexers. Professor Kramers has written the seminal paper on active share. Basically, high active share is winning the day. If you have lots of overlap with the benchmark, by definition, that capital can't beat the benchmark. Couple of things that indexing doesn't give you, which helps active management, is potentially greater mispricings, greater opportunity. I am nominally the chair of the research committee of the Active Managers Council. This is one of the tracks that we're attacking, is this idea of market, whether it's efficiency or new opportunities be creating because markets are becoming less efficient. It isn't clear to me that investors are willing to just buy what's in the benchmark at the benchmark weight without any forethought of valuation, fundamentals, or corporate governance. And lastly, it isn't necessarily that active managers will outperform the down market, but I think investors will want that optionality. Know that the indexes can't outperform the market because by definition they are. My final takeaway on this is that indexing is not going to kill active management, but very likely may kill bad active management. Managers that charge too much, don't have enough active share, turn their portfolio over too much. Active management is not going away. Bad active management is probably going bye-bye. I won't cover this for the sake of time. I'll simply quickly say all of those 5 variables that I mentioned, at least 4 of them require good security selection. Only lowering your fee alone in the absence of security selection will actually improve the performance of active managers. Going down the list, the ruthless pursuit of alpha. If you're not finding the stocks through this ruthless pursuit, it's not going to help. High active share. If you pick the wrong stocks, high active share doesn't help you. If markets become inefficient, but you're not in the inefficiently priced ones, it won't help. And if the market goes down, but you're not prepared for that, you're not going to outperform. So at least 4 of these 5 factors still require good security selection, which means manager selection matters. I just went back instead of forward. The final passives knockout punch. Martin mentioned this, the 1991 paper from Bill Sharp. If you haven't read it, you don't have to. You've all heard it in one form or another. Take all the active managers and all the passive managers, throw them together. You get the market. By definition, the average active manager has to have the return equal to the market before fees. Once you add fees, the average manager has to, by definition, underperform. First of all, I would argue there's not a ton of empirical evidence to support that. When you look at long periods of time, we find lots of asset classes where the average manager had their underperformance or outperformance doesn't look anything like the benchmark net of fees. In some, the average manager dramatically performs the benchmark, and some they dramatically underperform. This is the only one of the only research studies I've ever read where in the introduction they basically say we don't need any empirical evidence because the logic is so flawless. That scares me a little bit. But I would say even if this were true, and I'm not convinced it is, but I'm willing to grant it for this one afternoon, are advisors and investors really seeking the returns of the average active manager? This logic assumes there's no way to pick good active managers. Professor Kramer's research study that he just showed summarized that there are ways to do it if you focus on certain factors. So how do we take managers who aren't making and get them up index or above the index? What percent of these managers can really outperform? Well, let's do a few things. Let's eliminate all the structurally overpriced funds. Let's eliminate all the funds that don't have enough portfolio flexibility or high enough active share to outperform. And let's eliminate all the funds that have really high turnover. Another factor that Professor Kramer's has highlighted in his research. Then what does the world look like? Do you still have less than a 50% probability? Well, I took the hardest asset class I could find to beat the benchmark, Morningstar's US large cap blend, and did a very back of the envelope calculation. There's all kinds of look back bias in this. There's some survivorship bias, very back of the envelope, take it for what it is. The last 10 years, I use median statistics because not all the statistics are available for all the funds for the whole time period. But I did a simple sort. There are 563 funds, 94% of them outperformed. That was 17% roughly. I then eliminated all the funds that didn't have 80% active share. I eliminated all the funds that were above average expenses, which the average was 109 basis points. And I eliminated all the funds that had greater than 50% turnover. That got rid of 93% of the funds, and now 16 outperform 39%. I didn't get up to 50. I picked a really hard asset class, but think of it this way. By doing a brain-dead due diligence screening that my 10-year-old daughter could do if she stole my Morningstar password, I just doubled your probability of picking an outperforming manager. I didn't even actually do any real due diligence. This, to me, is winning the loser's game. It's not about finding the world's greatest manager. It's about avoiding structural laggards. If you avoid the structural laggards, you're probably going to find a good manager. I'm out of time. I'll sum it up with my 3 points. If you understand how active portfolios are different on average than the indexes, then you generally know why and when managers do really well or really poorly in a particular period. Point 2 is portfolio Darwinism. I think the competitive pressures of indexing is good for the active management industry. It's going to fix a lot of the problems we've had. And point number 3, investors are not doomed, even if you believe the arithmetic of active management, that the average manager is likely to underperform net of their fees. This does not doom investors to buying bad funds if they focus on the right manager selection characteristics. With that, I'm out of time. Thank you very much for listening.